Welcome back to the Seven Figure Annuity Sales Podcast. It's Caleb North here, and I've got some exciting stuff to talk about today. Last week, I actually had a conversation with some agents that were curious about talking points, just general talking points. And the context of their questions were primarily geared toward like seminar type presentations, right? Where they wanted to be able to go into a room of people, have their PowerPoint, the presentation slides and everything. And on those slides, have some good talking points that can open the door for annuity conversations, right? The annuity kind of piece was not their number one product, but they want to be able to get into kind of cross-selling where it's appropriate. And it kind of inspired me to think through this podcast for today, where, I'm just going to talk about some talking points. And truth be told, these are things that whether you're, looking to get into annuities from another line of insurance or you're primarily selling annuities already, these talking points can be used to help get the client's wheels turning, but also help paint the picture of the value of the products that we have. And generally speaking, I always recommend talking about a few of these, but I've got four. I'm going to jump right into it. We've got sequence of returns risk, the 4% rule, long-term care, and then returns. Okay. And so we're trying to kind of hit this from a couple of different angles. And as we always say, the fact finder is going to be what tells you what the client needs, right? So you may not necessarily need to be talking through long-term care with somebody that their primary objective here is accumulation and they have their long-term care more than covered. You might not need to talk about, average returns with somebody that is primarily using an annuity for guaranteed income, right? So you have different facets of these talking points, and they're going to have different value for different people, but I recommend having the knowledge and kind of the ability to talk about all four of these things in your tool belt of conversation. So starting out, we're going to just talk about sequence of returns risk. What is it? Well, sequence of returns risk is really the idea that you take compounded reduction in your retirement accounts by way of your retirement accounts staying at risk while you take distributions. Okay, so think of it this way. If I have $1 million account and, I'm going to follow, let's just say the 4% rule, and the market's down 10% and I pull 4, I've negated 14% of that value in one single year. Now my million is worth 860,000, excuse me. You do that enough and you put that account in serious jeopardy of not lasting for the entirety of the retiree's lifetime. Okay, so sequence of returns risk is that concept that you're taking losses while you're taking distributions. If you eliminate the downside, you almost entirely eliminate sequence of returns risk, but not perfectly, because even if you eliminate losses, if you have enough 0 years where there's no return, you can still see a reduction in that count value. So the only real way to eliminate sequence of returns risk entirely is by guaranteeing the withdrawal, aka the income, regardless of what happens in a sequence of returns and regardless of how long somebody lives. Okay, that's really the only way to eliminate sequence of returns risk. And here's the thing too, if you look at the numbers, the typical withdrawal strategy that economists and financial advisors recommend clients follow is what they call the 4% rule. It was created in the 90s. I think as a means for asset managers to keep assets under their management, right? With the onset of the 401k in the 80s, you get into the 90s and you've got some people with these, large chunks of money, and it's like, hey, just bring that over to me, put it in an IRA with me, and we'll be able to get your distributions taken care of. And the 4% rule was created as a means to try and allow people to safely take withdrawals that with some reasonable confidence interval would last for the rest of their life. Well, the problem is let's just start in year 2000, turn of the century, 25 years ago. If somebody would have been following the 4% rule the way that it is written, starting just a few years after the 4% rule was created, starting in 2000, somebody would have run out of money by 2017. So the problem with the 4% rule isn't that the 4% rule can't work. It's that sequence of returns risk still exists. And that's an illustration of the issue of sequence of returns risk. When you look at those numbers and you take $1 million, any amount of money, the account doesn't matter. The size of the account does not create more or less likelihood of success, because we're dealing with percentages, right? So $100,000 account, your first year withdrawal following that 4% rule would be $4,000. $1 million account, your first year withdrawal following the 4% rule would be $40,000. Okay, we're dealing with percentages, so it's all relative, and they all flow the same. But if you look at somebody, say they had $1 million in 2000, they retire, they take their 4%, and then they adjust that 4% every single year for inflation, and then they calculate that new percentage on the original account value, that original million. That's how the 4% rule is structured. They would have run out of money by 2017, 2018. So sequence of returns risk is real. It's that idea of compounding the reduction of your assets, compounding the reduction of your account values because of potential loss in years that you also take distributions. Those distributions might be RMDs, but we're talking about 4% rule as well. You need to be able to talk with clients about the 4% rule, which I just explained how that works. You start in your first year of retirement, you take 4%, you increase that percentage each year for inflation, recalculate that percentage on the original account value, and voila, you have your income. Here's what's crazy. It's not guaranteed for life, and is often not nearly as much as what somebody could get with an even smaller amount of their money using guarantees. What do I mean by that? Let's say somebody has $1 million and they're going to follow the 4% rule. They take $40,000 their first year. We could take about $750,000 of that million and guarantee the same amount of income, that $40,000. Like right now, we've got products that for a 65-year-old, starting income immediately, right away, will pay them 7.5% of their starting premium. Okay, we're talking about people that are able to take $15,000 on $200,000 in premium. So our guaranteed amount of withdrawal is significantly greater than what somebody hopefully will be able to take following the 4% rule. But we can guarantee it for life, regardless of what happens in the market and regardless of how long they live. The beauty of understanding sequence of returns risk and the 4% rule is not to try and then take all of somebody's assets and leverage them into an annuity policy. It's to be able to help them see that with a portion of their retirement savings, their assets, they can create the guarantees they need so that the other amount of money that's left out, they don't have to worry about it. It creates peace of mind. We call it sleep insurance. You know you're going to get your income next month regardless of what happens in the market. So that $500,000 that's left out or whatever it might be, you're not having to feel the pressure and the weight of checking the stocks every day, because that's going to determine whether or not that you're actually able to have your income or whether or not it's going to last for the rest of your life. We're just taking a portion of the money and we're creating the guarantees. But the more you understand sequence of returns risk and the more you understand the 4% rule, the better you'll be able to help somebody see why using $700,000 of their million can guarantee what they need for the rest of their life with no risk of that going away due to market volatility or age. And it leaves that other, call it $300,000 for them to play with and just let it grow. And when you look at the tables, you look at the models, the numbers, it is just it is when you combine the peace of mind that insurance creates with the hope that they can have leaving a portion of their money in something that's a little bit more risky for the sake of accumulation, it creates a really, really nice setup. But you need to be able to talk about sequence of returns, and you need to be able to talk about the 4% rule. And you also need to know that we are able to, with guarantees, eliminate sequence of returns risk and guarantee more income for the rest of their life. So that's kind of two things that go hand in hand. The next talking point that I highly recommend you privy yourself to is long-term care. If you look at the numbers, the kind of the national average for a long-term care facility is about $7,000 a month. Okay. Well, the national average for Social Security is about $2,000 a month. Okay. What does that mean? That means that if somebody were to end up in a long-term care facility, they're going to probably need around $5,000 extra dollars per month to come up with that to be able to pay for that long-term care facility. Now, again, this is purely dealing with averages, right? I've got agents in California listening to this, agents in Florida listening to this, agents in Massachusetts listening to this, agents in Texas listening to this. I'm not going to come out here with the state averages. So you're going to want to look at what does it actually cost in your state or in the state the client is in, and you're going to want to use their actual retirement income streams, okay? And they're guaranteed streams, right? Some, in Social Security, maybe not guaranteed per se, but we feel pretty confident about it, right? I'm going to use these averages for the sake of conversation today. You're going to want to get a lot more granular, a lot more specific to your individual clients. But you look at the average of long-term care, let's call it $7,000 a month. The average Social Security, let's call it $2,000 a month. And somebody's going to need to realistically come up with about $5,000 a month. Here's what's so awesome about it. We've got products right now where a 65-year-old with $100,000 in non-qualified money can create the guarantees that they need to more than cover that $5,000 monthly shortfall in just 5 years' time. So by the time they get to 70 years old, they've got the guarantees in place needed to cover what those facilities would cost. So the way that I recommend talking about it is simply asking, you'll see this on our fact finder. We ask, how are you intending to pay for long-term care? That's the way we word the question. How are you intending to pay for long-term care? Not asking them, do they have long-term care insurance? We're not asking them if they have enough money saved to cover long-term care. We're just asking them, how do they intend to pay for it? Because we want to get into their mind. We want to understand, how are they thinking about this? Are they thinking about this? And they might come back and say, oh, well, I won't have my mortgage anymore, and my Social Security, and I've got some assets set aside and all this kind of stuff. So, okay, it all comes back to the idea of what if we were to leverage a portion of what you have to create the guarantees you need. Just like sequence of returns risk, just like the 4% rule, all of it was geared around using a portion of the money to create the needed guarantees. Same concept with the long-term care. Right? When we look at the guarantees we're able to create with some of these products that are geared toward long-term care, we can take a portion of somebody's assets and create those guarantees to create the peace of mind. Guys, that's all insurance is designed to be, is use a portion to create the peace of mind, right? If I've got health insurance and I'm paying $500 a month for health insurance, and I were to go and end up with some medical issue that cost me $5,000, I have the peace of mind that I'm not going to have to pay all of that because I've been paying my monthly premiums. Now, I might have my deductible and whatever, but point is, we're using a smaller portion to create the needed guarantees that create the peace of mind. And I just gave you the numbers. A 65-year-old with $100,000, if they can get preferred health classification, they could, with products on the market today, create that $5,000 a month in guaranteed income for long-term care in just 5 years' time. Again, you're going to want to get specific, but you want to be able to talk about it. And here's the deal about the long-term care stuff, guys. This goes hand in hand. You might be talking with somebody about income. You might be talking with somebody about accumulation. You tack on the long-term care, two things happens. Number one, your client's going to feel like they're getting a lot more help here because you're approaching things a little bit more holistically. Number two, you end up writing a larger total case size. You might be able to tack on a $50,000, $100,000, $200,000 policy that's geared toward covering their long-term care, but you're using a portion of the money to solve different needs. Okay. The last talking point here is returns. And I want to preface by saying annuities are not equity alternatives. Annuities are not real estate alternatives. Annuities are not commodity alternatives. They are not any of those alternatives. If they're an alternative to anything, it's bonds. Okay. So we often end up with clients that they want to come at the annuity with the expectation that they're creating the same returns as their equity portfolio or whatever. All right. They're not going to do that. They're not designed to do that. But when you look at the numbers, they can still be relatively competitive. I want to go over some of these numbers with you. I'm going to have to glance down at my notes here. But if you look at, let's just take the S&P 500, okay? And these are numbers that I would encourage you locking into the vault and being able to rattle off at the drop of a hat. If you look at the average return of the S&P 500 over the last 25 years, so you go to the turn of the century, year 2000, we've got a 7.33% average return on an annual basis. Doesn't seem all that crazy. And we've got S&P 500 caps right now in our indexed annuities at 10.25%, 10.5%. We've got par rates at 50%. And we're saying the average S&P 500 returns is 7.33. It is. And the reason it's that low is because you have to factor in the loss years. Everybody loves to talk about, oh, last year they did 24%. Nobody likes to talk about the years where they took negative 15. But it's all of that coming together that creates your actual annual average return. The average return, if you were to take none of the losses of the S&P 500 and only half of the gains, is 6.28%. You're talking about 1 point less in an average by getting only half of the upside. You get half the gains, but by taking none of the losses, your average is only 1 point less. That's pretty stinking good. But here's where it gets even better. The average returns are not what determines the most lucrative strategy. The annualized return is what determines the most lucrative strategy. And the annualized return and the average return are not the same. The annualized return is if you take a starting point and you take an ending point, and you were to take the total amount of growth and you divide that growth into an annualized compounded return. So if I were to get one set interest rate every single year compounded on itself, what would that percentage be? That annualized return is what determines the most lucrative strategy. Guess what? The annualized return of the S&P 500 since 2000, so the last 25 years, is 5.89%. That's saying that if you could get the exact same returns in the S&P 500 as it did over the last 25 years, it would be the equivalent of having a 5.89% compounded return. If you take the annuity side, you look at I'm sorry, I lied to you. It's 6.28. It was a 6.28 annualized return. Okay. Now we look at the annuity. We say we're going to look at the annualized return of if you took half the gains and none of the losses. You want to guess if it's higher or lower? 6.31% annualized. Let that sink in for a second. If the annualized return is what determines the most lucrative strategy, it determines whether or not I gain more interest or less interest, and really it's dollars. If I end up with a larger account or a smaller account, I want the highest annualized return. The highest average doesn't matter. The S&P 500 itself has a 6.28% annualized return since the year 2000, the last 25 years. Half of the gains of the S&P 500, but none of the losses, has a 6.31% annualized return. What does that mean? That means that if you could choose an option over the last 25 years where you got only half the gains and none of the losses, you would have ended up better choosing half the gains and none of the losses. Now, I understand that the implication of that is that it's effectively a 50% participation rate in an indexed annuity, and that 50% participation rate holds for 2.5 decades. And the reality of the situation is that's not going to be the case, right? We will see some drawdown. But the point is to illustrate that you don't need all of the upside to end up dollars ahead. So if clients want to have a conversation with you about returns, use numbers and show them that you don't actually need all of the upside, and subsequently taking all of the downside as well, to end up dollars ahead. There are real situations where eliminating the loss is worth more than all of the gain. Okay? And so when you want to talk about 4 things that I would encourage agents to be so privied in that they can just talk about with clients: sequence of returns risk, 4% rule, long-term care, and returns. And being able to understand the traditional methods that people are using in these different areas and what they're used to and accustomed to, in contrast to what we can do with insurance, what we can do with guarantees. And if you can grow and study these 4 areas and become so well versed in these that you can just talk about them, I guarantee you your client conversations will be better and more compelling. I guarantee it. So I know that was a lot, and I kind of was rattling off a lot there. You might have to go back and listen to it a second time. And we train on a lot of this in our Retirement Realized Agents Academy. So if you want to deep dive some of these concepts, get plugged into the academy as well. But I'm telling you, you study these 4 things coming out of 2025, and you're well versed in them going into 2026. Watch your 2026 appointments just get way better. So I hope this helps you. As always, happy selling.